Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. Today, we're excited to bring a nice show to you. I think you'll find it interesting, especially if you're a person who's looking to transition from the business world and then go into commercial real estate investing. We have an individual here who's done just that, Mr. Neil Shahi. I pronounced your name correctly, right? All right, Mr. Neil Shahi. And thank you for being on our show, Neil.
Well, thank you very much for having me on the show. Very glad to be here.
Yeah. So Neil has a very interesting background, and I think it's an interesting story to tell because he's an individual who's worked throughout corporate America in various careers in various fields. But he ended up as a commercial real estate investor in I guess one might call the twilight of his life, if you can call it that. And so the story in that journey, I think, is really, really interesting. Neil, to start out, why don't you tell us a little bit about yourself, your background? You were born and raised in India. So tell us a little about that story, making the transition physically from India to the United States.
So like a lot of immigrant stories you hear, I came here as a graduate student. So got my MS and an MBA, a couple of graduate degrees. So it's a lot of people from India, very, very similar stories you will find. They come here for school and ended up, again, working on the corporate side in the corporate America for more than 2 decades that I worked in. And then last 4 years, I've been transitioning into full-time commercial real estate. And I can get into why we were looking. I was always an entrepreneur, and I had my own consulting practice on the business and the technology side of things.
Right.
And one of the things is an occupational hazard of consulting is you have to travel almost all the time.
And so you wanted to get out of
right. So after a while, it gets it gets tiring. So I was looking for something like an alternative. What else can be done? And and I had been looking into real estate. I owned real estate before. Also, I was doing single family. So this was a much better way to scale up. And that's why I got into real estate.
Okay. And you say you started that journey about 4 years ago?
Into commercial. And I had done single family before.
Okay. Yeah. So making that transition from owning single family properties where you're collecting rent, but you're exposed to a lot of risk because if that one tenant stops paying, now your rent goes from 100% to 0%, right?
Yes.
So there's a lot of risk when you do that. But was that a hard jump to go from owning and renting out single family properties to doing multifamily properties?
It did involve quite a bit of mind shift, actually. And I had to spend a lot of time and energy in educating myself how to go about doing it. So I got hold of some coaching, mentoring to help with that transition. I know people who have done it without that also, and it sometimes maybe takes a little bit longer then. And a lot of networking and education is is key for all this.
Right.
And so all that helped with the transition. The problem you said, the risk part, right? So it's a lot more scalable. You can scale to much larger number of units, and contrary to what a lot of times people think, it's probably a little less risky, and it's easier to scale because you have scale advantages, whether you are borrowing or you are doing property management. So all those advantages are there.
So I would imagine as you made that transition from residential to commercial real estate, looking back, there was probably some things that you wish you had known when you were making that transition. What are some of those things that you know now that you wish you had known at the beginning of this transition into commercial real estate?
I would probably invest more time and energy in educating myself. That is, I find it's like a number one issue. not only with myself, I see so many other people trying to make that transition,
Right.
and investing the time and the energy in educating yourself, whether it's through podcasts like this, or reading books, or attending conferences, meetups, because a lot of this is really not available in the formal education world. It's very hard to get it that way. And you have to really keep up with what's going on in the marketplace, whether it's the debt markets or the equity markets, or what's happening on the market side, for example, at the brokerage level, or the sales side. So keeping up with all this, it becomes almost a full-time job in itself.
Yeah.
So it's hard to just dip your toes in this. You have to jump in fully.
Yeah, you have to be fully committed.
Yes.
Yeah. And so now there are a lot of disciplines that are associated with commercial real estate. As you mentioned, if you're going to be a commercial real estate investor, you have to understand the economics of a deal.
Yes.
Then you have to understand the capital markets, what type of capital is available. Then you have to understand the equity side, how you're going to raise capital if you're not putting all your own into it. That's quite a bit of learning.
Yes.
But you were able to navigate that to your first deal in what period of time? So from the moment you decided you're going to do commercial real estate to the moment you did your first deal, how long did that take?
It almost took good 8 to 10 months. Because even though I knew the business side of things, I had an MBA, I understood accounting and finance and marketing, all of that. Still, to network with people, the brokers, to find the right debt, to find the right partners to partner with, to network with people, get all the providers, assemble your whole team, if you will. All that takes a while. It can take a while. And also to find the right deal, that's something that pencils out, that works out well. So, and you have to really underwrite a lot of deals to find something that looks good, right?
Yeah.
That will work.
Yeah.
And if you remember a few years ago, things used to be so competitive. It's not like what it is today, right?
Right.
So you have to really build a lot of relationships, for example, even with brokers, to find deals and get deals.
Yeah, and that is key. Some may feel that I'm going to make a transition into commercial real estate and I'll find those deals are going to come running to me and I'll put my offer in and I'm going to get that deal.
Right.
It's not quite that easy, is it?
No, it's not. There is a lot of work involved, and I wouldn't, that kind of, I have seen people who think like that and people get very disappointed taking that approach.
Yeah.
It doesn't work out. Even in the present market, it won't work out. And it's very risky. If somebody jumps in by mistake, something happens.
Right.
You have to go take a very conservative approach and really make sure, vet out all the numbers, all the your business processes, your partners. All that takes a while.
Yeah. So when you did your first transaction, were you the single investor in that transaction, or did you have other investors? Perhaps, maybe, did you do a syndication on your first deal?
Yes. So it was a syndication. So I had other investors in the deal. Yes.
Okay. Now, how was your syndication structured for the benefit of our audience? When we say syndication, that's where we have a group of investors. They come together, they pool their money together, and they make an equity investment in the deal. But the members of that group basically take on different roles and different responsibilities.
Right.
Some might be considered what's called a GP, which would be the general partner, and then some may be considered LPs, which means that they're limited partners. How was your deal structured? Something like that?
Exactly like that. So like a typical syndication deal, you have the GPs and the LPs, right? The general partners are more involved. They put the deal together, they find the deal, they do the acquisition, they find the debt, they then raise the capital, right? From all the limited partners and their own money also. And limited partners their liability is limited, right? So they are the passive investors who provide also the capital, bring capital to the deal.
Right.
And so And that's how these deals get put together.
So in addition to that general partner pulling everything together, basically being the quarterback, if you like football, being the quarterback or coach that pulls the deal together. He's also oftentimes signing on the debt.
Yes.
Which is a really big deal.
Yes.
Yeah. So that person is putting their balance sheet up.
Yes.
And how important is that in that relationship where you have the GP and the LP? How important is it to have someone to sign on the debt, and what qualifications do they generally have to meet in order to sign on debt?
So first of all, you have to have very clean background and history, because the lenders and everybody, they will go through a fine-tooth comb with everything. From your credit scores, plus you have to have net worth and liquidity, the post-closing liquidity to qualify. There are different loan programs, they have different requirements, but they want to make sure that you are financially stable, that you have background, you have been stable in the past, and that you can carry this forward. Lenders are really looking for people who are going to be responsible with their loan, because in effect, they are the biggest investor in the deal.
Right.
So they want to make sure of all of this. And everybody who signs on the loan, I mean, it's a very big responsibility.
Yeah. And so now your first transaction, were you a GP or an LP?
I was a GP.
Okay, wow.
Yeah.
So your very first transaction,
Yes.
you went out, put the deal together, found the investors, signed on the debt.
Yes.
Wow, that's pretty risky.
Yeah, but I had other partners also with me.
You had co-GPs on the deal.
I had co-GPs. So you have to find people who are experienced into different areas.
Okay.
So they fill the gaps where you lack, right? So that's how using other people's experience to flesh out the whole team.
So now, have you ever invested in a transaction where you were the LP?
So in my own deals, yes.
Okay.
Because as an LP also, I invest alongside.
Oh, so you come in as a co-GP and you take a LP position as well.
Yes.
Okay. But you've never gone into a transaction where your sole role in that transaction is just an LP.
No.
Okay.
No.
Yeah. So you felt comfortable, and it probably gave you a sense of more control.
Yes.
And that's probably why you did it.
Yeah, but I have done JVs before, joint ventures, which is a little bit different than syndication. So same thing, I've been doing JV with other folks, for example, for land development and things like that.
Okay, yeah. So now, as you gone through this experience of your first deal, do you still own that property, or have you still exited out of it?
No, we still own those properties.
Okay.
Yes.
Yeah, and of course, we've seen a lot of adjusting in the markets here lately.
Yes.
When did you initially buy that property?
About 2.5, 3 years ago.
Okay, so you bought the property when cap rates were really low.
Yeah, you could say so compared to what it is now.
Yeah.
But we did not pay low cap rates even back then, because a lot of these were value add properties, and these were like you would call B minus class in the ABC classification for multifamily. So we did not buy at very low cap rates, and we modeled, and which is very important for this, we modeled such that even if cap rates expand, we had enough buffer, and we modeled it like that.
Okay, so you built in that risk factor into your deal,
Right.
And really that's the importance. One of the things that you mentioned when we talked about making that transition from residential real estate to commercial real estate is really understanding the economics of a deal. Right. And I appreciate the point that you made about how you have to underwrite a lot of transactions to find the one that works.
Right.
Because there are a lot of syndication groups going out there just buying stuff, hoping that these cap rates would stay where they are.
Right.
And they didn't build that risk in.
Right.
And now that cap rates have gone up, the value that they thought they were going to get out of the property, they're no longer going to get.
That is true.
And they probably are near default on their loans.
Right.
So that was, and I can understand that's where your finance and accounting education came in to help you, would you say?
Yes, absolutely. I mean, you have to take a conservative approach because there are so many things that can go wrong that are beyond your control. Like this is a very good example where markets change, right? So and then a conservative way to do would be to think maybe add 50 basis points each year of your whole period. So if you are, let's say, you are projecting your pro forma for 5 years, so you add 50 basis points. So that gives you a good cushion. And if you can still make the deal work, yes, it's absolutely.
So now, have you been in a transaction where things unexpectedly happen? Perhaps, we've seen the pandemic. It sounds like you owned your property, probably bought it right when the pandemic started.
Yes.
So you had to go through that. We were dealing with labor cost issues. We were dealing with material shortages.
Supply chain issues.
Now, did you factor that risk into your deal, or did you have to go out and do a subsequent capital raise during the middle of your deal?
No, we did not have to do a capital raise in the middle. What did we do? So when we did the capital raise, you raise a little bit more than what is needed just to have a cushion.
Yeah, the buffer.
Just a buffer. So that carried us forward. That helped us tremendously. And also we watched our expenses very carefully throughout. So just to handle these risks, for example, even throughout the pandemic. And the pandemic, yes, it was a black swan event. We didn't know what would happen. Nobody, I think, knew. But we came out okay because no matter what happens, and now we have learned, people still need a place to stay.
Right.
So it's an asset class that is fairly stable. Even in the pandemic, it came out compared to a lot of other asset classes. This did not suffer.
Okay.
Especially multifamily, I mean.
So in 2000, I would say in the latter part of 2019, 20, 21 for sure, we're dealing with the pandemic and it had its own special challenges.
Right.
2022, we're coming out of that. Things are looking like they're starting to stabilize.
Right.
Didn't the Federal Reserve Bank decided one day that they wanted to start raising the interest rates to lower inflation by making things more expensive. I think that's called inflation, right? But anyway, and do it in such an aggressive manner that it's really put banks and a lot of investors at risk. How has that impacted you, your properties, your portfolio?
So we do have, on one of the properties, we do have a variable rate interest loan. So before we closed on that property, we bought something called interest rate cap insurance. And if you have that, then your exposure you're trying to hedge your risk. You're trying to limit your exposure. And that's what we ended up doing. So which came in very handy at this point where the interest rates have shot up tremendously. So our risk is very limited because of that.
That's very smart. Interest rate cap insurance.
Right.
How does that work?
So this is a insurance product that you buy, and many banks sell this, where your risk is limited. You say, okay, if the interest rate, or let's say, so our interest loan was indexed on the SOFR, and if let's say SOFR goes above 1.75 or 2, something called a strike rate, if it goes above that, then the bank covers that portion of the interest payment.
Is that like an interest rate swap type
Yes.
stuff? Okay.
Yes.
Okay. Well, I guess first time I've heard it explained like
no, it's not a swap.
But it's very similar to
an interest. Like an insurance.
But it is it a third party, or is it something the bank does?
A bank does.
Wow.
Many banks offer these kind of products.
Okay. And how is it different from an interest rate swap? Because it sounds very similar to a swap.
So this is not really a swap product. These are like many banks offer these their derivative divisions have these products, and the lenders these days require, if you have a variable interest rate loan, lot of lenders will require a specific interest rate cap on your debt. And then people end up buying them. A lot of people were buying on their own just to limit their exposure.
Yeah. Well, I would imagine the insurance companies that wrote those policies are suffering.
Yes.
Because it's not a issue that the rates have gone up, that they've gone up so fast.
Yes.
And I think that's what the Federal Reserve is trying to deal with a inflation issue that has a lot to do with consumerism and at the consumer level.
Right.
But our economic system, our whole interest rate system is combined with consumer spending and corporate spending and real estate investing. And while they're trying to fix a problem, that may work under the isolated bubble of consumerism, it has horrible effects and horrible implications when it comes to corporate debt, when it comes to banking, when it comes to commercial real estate.
Right.
It really has exposed a significant flaw in our system. Based on now you worked for Fannie Mae.
Right.
Freddie, did you work for Freddie?
Freddie also, yes.
You worked for Freddie, you worked for the IRS.
Yes.
You had a pretty broad career.
Right.
So based on what you've seen in the past, what do you think the long-term impact will be of some of the decisions that are being made now with the Federal Reserve Bank?
It's very hard to predict the long term. None of us really have a crystal ball, but it can cause a lot of damage. Interest rates going up in the short term, it definitely has caused a lot of issues. The debt markets throughout. Not only in commercial real estate, but even in other fields, which they depend very heavily on borrowing to run their business. And when their costs go up, they increase the
rent.
The rents, for example.
Absolutely.
Yes. So everybody ends up paying for this.
Right.
So on one time, for example, the Federal Reserve is trying to contain inflation and by increasing interest rates, but we have now forced to increase rent, which now people have to pay higher rents because of this.
Right. So they may not be using their credit cards as much,
Right.
but the money they would have been using for consumerism or consumer products, now they have to use that to pay the rent.
Yes.
Okay. And now, of course, if their rent has gone up, they can't pay the credit card. Now the credit goes bad. You're creating a cycle that intentionally drives the economy into a recession.
Yes.
And it's going to be a very difficult recovery. Now, knowing that, seeing, and these are things that the technicals are very clear. With the approach that's been taken now, there's no question that we're headed for a recession. How do you protect yourself as an investor in commercial real estate, knowing potentially what's going to happen over the next 3 to 5 years? And I think they say it's going to be a short recession. I think it's going to be at least 7 years to recover.
So if you're evaluating deals or looking at any new projects, make sure that you do it conservatively, that you can withstand the interest rate risk. Do your what if analysis, right? And figure out if the interest rates goes up, does your deal still work? Is it still cash flowing? So you should not have such a thin buffer that your deal falls apart if your interest rate goes up by, let's say, 100 or 200 basis points, right? Also, if you have variable rate debt, look at getting interest rate cap insurance.
So you mentioned this interest rate cap insurance. Do you think it's still available with the rates going? It seems to be very risky, and if it is available, it would be quite expensive.
It's still available. It's become quite expensive now. You're right. A lot of people, to avoid that, now people are getting into fixed rate debt just because of this issue.
Now, are you still aggressively looking at deals or looking for deals?
I am looking for deals, and a lot of deals these days are not penciling out,
Right.
especially in the multifamily space. So I also do land development. So we're putting more energy into that. I'm looking at hospitality in hotels, trying to underwrite those deals also.
Okay.
Because the cap rate is a little bit higher, so you have a little bit buffer in that area.
Okay. So as you continue to look at these new opportunities, I know you're focusing more on real estate development, but no doubt you are seeing other opportunities come your way. Do you see the market adjusting to this new reality of a higher interest rate environment? And what I mean by that, do you see the sellers adjusting their cap rate expectations?
Now, there is still a very wide gap, between what sellers are asking and what buyers are willing to pay at this point, because there is big gap. And all of these brokers I speak to, they're all struggling with this. Their expectations have still not completely aligned with the reality of such high interest rates.
Right.
And that is why a lot of these deals are really not penciling out.
Right. Yeah. And we see that. And I think we're going to see a very large inventory buildup in terms of properties that would have transacted, because we had a really fast, robust transaction, market here 6 months ago. Deals were transacting very quickly. Deals were getting done. Now that's slowed down quite a bit. But what I see personally is that these individuals who were not able to sell their properties prior to the beginning of this new reality, this new cycle, the economics of their deals don't match what the market is willing to pay right now.
Yes.
Yeah. And so, and what I suspect is going to happen, it'd be interesting to get your thoughts on this, in the next 18 months for certain, that you're going to see a lot of these multifamily properties start to default. What are your thoughts on that?
Yes, you're right about that. The only saving grace is some of these deals have an assumable loan.
Yeah.
So when you can get hold of a property like that, where it has a loan that is at a lower interest rate and you can assume, then those deals are workable.
Yeah. But generally, you have to come in, that buyer would have to come in with a significant amount of equity to make that deal work.
Yes.
Even if the debt's assumable.
Absolutely.
Absolutely. Because of that gap between what they're selling it for and what they bought it for, what they thought, their cost basis is. So I think the markets are going to be interesting. Now, do you plan, as you kind of, transition your property, because you have a couple of properties that you bought 2 or 3 years ago with your syndication group. Are you in a position to where you can hold those properties and just kind of wait this cycle out? Or does your exit strategy cause you to have to sell in the middle of a new economic reality that may be unfavorable to you?
No, we are in a position to hold it out, and we most likely will. We are still executing our business plan. We are doing all the CapEx, all the rehab work. A lot of these properties are what is called value add, right? So we are still doing all the enhancements and the upgrades that we want to, and that usually it's a multi-year thing. So that's ongoing. We are trying to drive up the NOI, the net operating income up. That's still going on, because that is the saving grace. If you have a deal where there is a lot of opportunity to value add, so that gives you a cushion also, where you are constantly increasing the revenue of the property.
Yeah. So now, just to kind of shift gears, there's another phenomenon that's occurring with the advent of the syndication groups, syndication world. Large cities used to have a large inventory of class D plus, C, C plus, B plus properties, right? And we have this now, I would say over the last 10 years, well, actually since 2012, when President Obama passed that the Jobs Act.
Right.
And in the Jobs Act, that allowed us to be able to create these syndication groups and go out and raise capital. And so these groups have come in, they've raised capital, they've purchased these C-class properties, they've improved them, made them nicer places to live, but they raised the rents to the point where blue-collar workers and gray-collar workers no longer can afford to live there. And as a result, we're seeing homelessness and we're having major affordable housing issues. How do you balance, your business as a businessman? You have a job to go out and improve these properties, and it has good for the community. But at the same time, if we're raising those rents aggressively, it's also having a negative impact on society. What are you guys doing to make sure there's a healthy balance in that regard?
So it depends on each property has a different business plan, right? So a lot of these value add properties, yes, it is dependent on adding new amenities and upgrading units and which so that you can increase the rents, right? That is the business plan. But there are also other projects, and I'm not in one of those, but like the affordable housing you talked about, and there are government programs that are for those. And that's a very different, those are very different kind of projects. And my heart goes out to for issues like this, but it's a different project. It's a different property, all the affordable housing. For example, I know people who are converting hotels right now, so some of these all-suite hotels into affordable housing, like micro units, affordable housing. So that is a very different kind of project. And I know people are working on those. There are different groups working on those. They specialize in that.
Right.
And the government is incentivizing for that. They are providing special loans for that, just for affordable housing.
Yeah. And so with regards to the C-class and B-class properties on the development side, it used to be where developers would come in and they would develop across all categories.
Yes.
But now when people go and develop, it's usually they're starting at A-class properties. Do you see in your development activities where you would go in and develop a C-class or maybe C-plus class properties for the specific purpose of making sure that we have housing available for our gray collar and blue collar workers?
I've seen that become so rare now to develop a C class, right? Hardly anybody constructs anything to be C class to begin with. Right. By definition, most places it ends up becoming a A class or a B plus at least, right? But there are government programs like LURA and the low income housing credit and all that, that a lot of times they incentivize and they provide funds or tax abatements. But that is for take an existing property, rehab it, and then there are rent controls on that, those kinds of properties. So those are very different projects.
So what do you think as members of the industry, my property I own is an A-class property. And it's and our rents are probably the highest rents in that particular market. But I think we have a responsibility as owners and operators of multifamily, in Texas, throughout the world, to give consideration to the affordable housing issue. What do you think as an industry that we could be doing while we have our business plans that improve the community, improve properties, takes properties at the end of its life cycle and it upgrades it towards a nice place in the community. And that's an important business plan, which is what you're doing.
Right.
But in addition to that, what do you think as an industry we could be doing to, at the same time, address the affordable housing issue?
So this requires, I think, a public-private partnership working with the government to affect policy so that you have the right policies in place to incentivize this so that more people can invest in projects like this.
Right.
It can't be done just by private industry because the costs are too high.
Right.
So you have to have some tax abatement or some advantages
type of incentive.
and some kind of debt specially tailored for programs like that for affordable housing to make this happen. So both things have to be there together.
Yeah, and you bring up a good point, and that should not be missed. One of the reasons we talked about developers not building C-class and B-class properties is when you factor in the cost of land. Because we decided that we're no longer a nation of immigrants, or we don't want to be for whatever reason. Now we've created labor shortages, and we still have ongoing supply chain issues, which feeds in, it's part of that is due to labor shortages. It's going to have an impact on that. It's just simply not affordable to go in with the purpose of building C-class or building B-class. Because of some of our policies that have been put in place.
Right.
So that was a good point that you made. And to your defense, you're serving a part of the business industry that's needed because we need to upgrade these properties that are at the end of its life cycle.
Right.
But at the same time, as an industry, we have to figure out how to address the needs of those who are less fortunate.
Yes.
Those who are perhaps homeless or having affordable housing issues.
Yes, I completely agree.
Yeah.
Yes.
So now, given the depth of our conversation today, we've talked about some of the economic issues that are facing the multifamily industry today. We've talked about the complexities of putting a syndication group together. We talked about the credit worthiness of a general partner. Would you say that going from flipping houses to jumping into this industry is something easy?
No. It's not easy. And if you are, if you don't have the time or the commitment, don't do it. Just invest passively with other people who are doing it, who are pros at this. This is definitely not for everyone.
Right. Yeah. It takes a very unique skill set.
Yes.
You mentioned your networking groups. So you have to have the relationship.
Yes.
And that's relationships that throughout the entire process, dealing with your brokers who are selling the property, making sure they're identifying the right property for you. You have to have the right economic or financial skill set. So that a deal when you see it.
Right.
You can go and do that underwriting personally, and you're not relying on someone who perhaps could be fallible or maybe have motives different than yours. We talked about understanding the importance of having the right team in your syndication group. Have you seen syndication groups come together and they're not the right people?
Yes, absolutely. I mean, syndication groups, they are like getting married almost, right? And you have to make sure you have complementary skill sets, you get along, your values and ethics are aligned, and then you execute the business plan. If you don't get along, then these things become very, very difficult.
Right. Yeah. So there's a lot that goes into it.
Yes.
And congratulations to you because you've taken your skill set, your industry experience and knowledge, your personal desire to be, a captain of your craft. You've used that to make yourself successful. And so congratulations in doing that.
Thank you.
We certainly appreciate you being a guest on our show. And maybe as you get into some of your other development projects, we'd love to have you back and you can tell us about your experiences related to that.
Sure. And then thank you very much, Charles. Thank you for having me.
All right.
And wish you the best.
Well, Mr. Neil Shahi, thank you so much. And we look forward to having you again. And if you have any questions about getting into commercial real estate, or what that journey and experience is like, definitely tune into our show or reach out to myself or Neil. As information will be on the screen. But one thing I want to make sure that I remind you to do, when you see this podcast and you look at the value of the information that we discuss, please show your support by liking and sharing this on YouTube or whatever podcast channel that you're looking at. And then also follow our social media. We have some great content on our social media, and we're involved with all of it. I think Instagram, TikTok, I can't remember the other ones, but all the social media. If you're younger than me, you probably know what it all is. So, but definitely follow us on social media, and please remember to like and share. But until then, please join us again for another episode where we talk about everything real estate here on the Capital Playbook.